Okay, good morning. So, basically, what we looked at previously is this concept of aggregate demand. Okay, now don't forget this is in a macroeconomic context. So, what we're doing is we're adding up all of the consumer demand throughout the entire economy from all of the markets. Don't forget, macro looks at an entire economy, micro looks at individual markets. So, when we come to add up all of our aggregate demand, we can see there's different components that make up aggregate demand. Okay, so in aggregate demand we have consumption, investment, government spending, and net exports. Net exports is the revenue from exports take away the spending on imports. Those four components make up our aggregate demand. And today we're going to look at one specific element of aggregate demand and see what are the factors that will influence the level of investment. So, first of all, what is investment? Well, investment means capital investment from firms. Okay, so it comes from the firms, it doesn't come from the consumers. So, what we're thinking about is not individual investors that are buying shares or that are investing in the stock exchange or things like that. What we're looking at are companies, firms that have some form of capital investment, normally for the purpose of growth, future growth. Okay, so the first element that is going to impact on the level of investment in an economy is the rate of economic growth. Now, don't forget how we measure economic growth. We measure economic growth using a measure called gross domestic product. Okay, so if we have increases, significant increases in gross domestic product, then firms will see this as an indicator to grow. Okay, so if we know that economic output is increasing, then firms are much more likely to increase their own output. How do they do that? They invest in order to grow and increase their output. So if the rate of economic growth is high, we can also expect investment to be high. If the rate of economic growth is low, or it might even be negative, we might be looking at some form of economic crisis or a recession, then we would expect if economic growth is low, we would expect investment also to be low. Okay, so think about that relationship there. Next, where do firms get the money from in order to invest? And the answer to that question is very simple. Normally, it is external finance. So it comes from a bank. Now, don't forget interest rates. The reward for saving, the cost of borrowing. Okay, so if the cost of borrowing is high, this will discourage firms from investing. If interest rates are low, then firms are much more likely to borrow money and invest that money in the growth of their business. Okay, so think about it. The government or the central bank of a country increases interest rates, this will reduce the levels of investment. Okay, if interest rates are reduced by the central bank, that could encourage investment by firms. Next, business confidence. It's a really important one at the moment. Imagine the levels of business confidence right now, today, are extremely low. So firms are scared. Firms are worried about the future. There is uncertainty out there. And therefore firms are less confident to invest. They are more likely to wait for the future in order to invest. Okay, so again, think about the relationship. Business confidence is high, investment high. Business confidence low, investment low. Okay, so that could really affect and influence the levels of investment. Next, availability of credit. Again, this goes back to where does the money come from for investment? And often it comes from the private sector, the banking sector. Okay, so if that credit is available and it is freely offered to businesses, for small businesses, for medium-sized businesses. If you go to a bank with a business plan, what is the likelihood of you being offered credit, finance, a loan? And if the availability of credit is low, you have less investment. If the availability of credit is high, if banks are quite confident in giving out money and they want to encourage entrepreneurs to develop the size of their business, and the availability of credit is high, then we're likely to see that investment is also high. Okay. The last one is a very simple one. Corporation tax is a direct tax placed by a government on the profits of businesses. Okay. Now that varies from country to country. So if a business does not get their capital for investment from an external source, often what they will do is they will use profits from a previous year, retained profits. Now, if those retained profits are smaller because they have been taxed more, then there will be less money available for investment, less capital available for investment. If tax rates on profits are low, there will be more availability of capital for the firm to invest. It is that simple. Again, consider the relationship. Tax is high, investment low. Tax low, investment high. Okay, now let's see what that looks like. Okay, what it means is if we have an aggregate demand and supply diagram, don't forget this is short run aggregate supply. We have our average price levels here. We have our output here. This is output. Okay, that's GDP there, look. Okay, these are our average prices. Okay, don't forget this is an entire economy. Okay, now what happens if investment falls or investment is reduced? Well, it has a direct impact on aggregate demand. It shifts aggregate demand to the left. And we can see two major effects. Average price levels fall, what we effectively know as deflation, and we have a loss of output. We're seeing a reduction in GDP. The level of output in the economy is falling. Okay, so think about it. This is one of these four components. Okay, and the changes in levels of investment will have a direct impact on an economy in terms of output, economic growth, in terms of prices, inflation or deflation. And we can also make an assumption about levels of employment, because if levels of output fall, we can also make the assumption that levels of employment will fall or unemployment will increase. Okay, right, we're going to move on. We're going to take a little look at government spending next. So keep your eyes open, watch these videos.